Okay, it's showtime. Hi, folks. In August this year, Stash.com reported the results of their first annual State of Money in America survey. And in it, they learned that 90% of Americans want to invest, but don't know where to start. And that when it comes to making investment decisions, only 13% of respondents said they feel very comfortable in their ability to do so, while 41% said they feel either somewhat confident in doing so or not confident at all. So, in my opinion, 87% of folks out there feeling either somewhat confident or not confident is evidence enough to justify us doing this webinar today and to continue doing them in the future. Of course, many of them just aren't making enough money to save, but I believe that a good percentage of them would if they could wrap their heads around the fact that it is possible for them to accomplish this if they understood that what is needed to achieve this goal, and it's really not out of their reach. So, because of this, I can't even begin to tell you how excited we are to be doing this introducing investment webinar with you again today. It's our third time that we have covered this topic since we committed to doing a monthly webinar 21 months ago in March of 2001. How about that, Rach? 21 months ago. Time flies when you're having fun, I'll tell you. It is certainly one of our favorite topics, and it always gets a good response in terms of people register for it as well. So, with that said, we have two goals for this webinar today. First is to educate you on the fundamentals of investing, and secondly, to discuss the different types of investing strategies that are available to us, to us all today, and especially the ones that we as a firm are gravitating towards these days, and why. It is exactly these strategies and our approach to financial planning that we think separates us from the pack when it comes to this topic and what we do with our clients. But before we do that, I want to thank each of you for joining us today to discuss this extremely important topic. My name is Brian Dougherty of PLC Financial Solutions, and I'm your host along with my beautiful, wonderful partner in business and life, Rachel Dougherty. Say hi, Rachel.
Hey, everybody.
She'll be our moderator for it as always, and she will be handling all of your comments and questions as we move along. But before we get started, let's take care of some general housekeeping first. First, if the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen to make it larger. Also, you'll see that there are two boxes at the bottom of your screen. One's called Chat, it's for your comments, and the other's called Q&A, and that's for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you will have questions and do have questions about the material that we will be covering today. But since we have a good bit to cover and only an hour to cover it, as always, going to ask you to put them in the comments and the questions boxes below, or you can also even email them to us at info@plcfs, that's Paul, Larry, Charlie, Frank, Sam.com. And at the end, we will be staying for some extra time to cover that, as many of them as we can. However, if we don't cover yours, we'd be happy to answer it by either email or even a 15-minute Q&A phone call scheduled for another time. Rachel will be posting a link for that before we end tonight. Next thing, this webinar is being recorded and it will be sent to everyone who has attended tonight. So don't worry about missing anything. You'll have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention, and because we'd like to have you have some fun as well, before we answer any questions, we're going to have our usual 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to the store of your choice. So make sure you have a notebook handy to jot down some brief notes related to some special bullet points. You'll see me do it, right? Bullet points that I'll point out to you as we go along. When I point them out, you better start writing. Finally, it's my obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got that out of the way, I have one for you as always. So an old lady goes into a bank and says to the younger guy in line with her, "Can you help me check my balance?" He says, "Sure." So he pushes her. I couldn't help it. My younger son, Tom, came. I don't know if he made that one up or not, but that was pretty good. We had a good chuckle over that, right, H? I promised Com I would use it on the next webinar, so there you go. All right, so I'll keep the day job as always. All right, so let's get started. So what does it mean to invest? Well, most of us know someone who was either born into or stumbled into financial security, and it's hard not to want that for ourselves. But the reality is, for the rest of us, financial security is not a given, and waiting around for a windfall is certainly not the responsible way to go about it. So it's our responsibility to build it on our own. However, almost got me. However, please don't get overwhelmed here, because our goal for this is to really just to show you how to have the money that you're already making work for you for the future. And that is investing. You don't have to be a market wizard to obtain financial well-being. You just need to learn a few basics, form a plan, and vow to stick to it. Investing is not a get-rich-quick plan. It is a long-term investment in your future. There's no guarantee you'll make money from all the investments that you make, but if you have a solid grasp on many of the options out there to invest and you stick with it, you should be able to grow your financial security while learning the benefits of money management. Okay, so now let's talk about your options. There are many ways to invest your money. You can own a business, buy a property, or even buy collectibles, which can all potentially bring high yields over a long period of time. This, by definition, is what investing is. And of course, if done right, they can all be wonderful ways to invest in your future. However, today we are going to be discussing investments that revolve around the stock and bond market. So, if any of you have been intimidated by the stock and bond markets in the past, hopefully we can educate you enough to lay all that to rest for now. Also, whether you're a beginner, at the height of your career, beginning your retirement, or approaching your golden years, let me tell you, it's never too early or too late to learn about investing and to start doing it. With that said, the two basic questions you should ask yourself before you get started are, what should I know? And why should I know it? These questions in and of themselves can actually be overwhelming for some people. There's a lot of information out there, and the investing world's terminologies don't necessarily bring much comfort to people either. Words like portfolio, even, or market capitalization, return on equity, active and passive investing, etc. None of them scream, "Welcome to the world of investing." But don't fret, because all you have to do is want to learn and you'll get there. Okay, so the number one thing that you should always consider when investing is the risk that you are taking on when doing so. So let's start out by looking at how the stock market works with the economy to help you better understand your risks as it relates to the stock, at least stock market based investments. So when it comes to the stock market, it pretty much goes hand in hand with the economy. And contrary to what most people think, especially right now, because it's been down lately as compared to last year and several years prior, it's actually fairly consistent despite the swings you hear about on the news. And these days, there seems to be a whole heck of a lot of them. With that said, though, you have to understand the big picture when it comes to it. And that is that the markets and the economy work in cycles together. Here are the three basic components that they break down into over time. The first cycle is known as the productivity growth cycle. Now, this is started by an increase in the labor market, or what's known as input into the economy, which then causes revenue and the gross domestic profit in our economy to increase. And that's also known as output from our economy. When this happens, money flows more heavily into our markets, both stock and bond markets. More people are working. The next cycle that evolves from this is what's called the short-term debt cycle. Now, this cycle is defined by a growth period and then a recession period that usually lasts roughly around 5 to 8 years and will account for both a boom and a bust. I kind of think we've had the boom a bit, and we've kind of been sliding a little. I don't think we're anywhere near a bust right now, but we've been sliding a little over the last year or so. It peaks when interest rates go up as loans become more expensive. So that's what's been going on now. The rates are going up and loans are getting more expensive. And then it busts when debt payments become higher than people's income or ability to pay their debts. So we're kind of working our way up to that right now, actually, thus causing a recession. And there's been a lot of prediction. Kind of a weird situation we have now, because the job market's been great, and usually during a recession, it slows down. And resetting our economy and our markets at lower levels, which then begins the cycle all over again. Now, the final cycle is what's known as the long-term debt cycle. Now, it works very similarly to the short-term cycle because it has a boom and a bust as well, but it's bigger and takes longer to cycle through, typically around 40, 50 years. It peaks when the economy has high debt and cannot take on any more, which means the economy cannot continue to lower interest rates anymore. We've kind of been through that. The result is that large amounts of debt unwind and the market will correct anywhere from 40 to 50% or more. And as you well know, it causes a lot of loss to lenders and to investors as well. Think of the roaring 20s versus the bottom out of the 30s and the 40s, the Great Depression era, or even our 2008 Great Recession. Even though most of these situations have similar results, there's usually several catalysts that are unique to the situation. So they're never really exactly the same, but the cycle's still, the end result is the same. With all that said, all you have to do is understand that these cycles have been going on since the inception of our markets, and that investing for the long run has always proved to pay off in spite of them. Then, once you do, the fluctuation in the markets are not as scary as they sound. In fact, once you do, you can even start to use them to your advantage, if you're so inclined. Okay, so what is a portfolio anyway? For many of us, the word portfolio brings to mind scary interviews or long nights compiling our life's work into one cohesive presentation. But in the financial world, your portfolio is simply the things that you own. It includes things like your retirement accounts, your investment accounts, such as stocks, bonds, commodities, commodity type investments, real estate, business assets, and etc. Whatever it is that you own, simple. Often people are at work building a portfolio without even knowing it. But having a clear vision of your portfolio is a good idea, because the idea is to create a balanced portfolio to limit your losses should you lose on any aspect of it. Now, to do that, it's a good idea to diversify. Also, when it comes to diversification, it's not only a very good idea to diversify the individual investments inside a stock or a bond-based market portfolio, it's also a good idea to invest in assets that do not correlate very much with each other when it comes to them as well. Things like real estate, commodities, art, collectibles, stamps, baseball cards, etc. Even wine can be considered a non-correlated asset or investment. Now, in fact, these days, even certain types of investing, which we'll discuss later, and even some investment-based annuities are even being used as non-correlating investments in the primary and stock and bond primarily stock and bond portfolios. Bullet point one, bullet point. So I'm saying it again now. Bullet point one, diversification is the number one most important rule to investing. Diversification is the number one most important rule to investing. Well, and why is it so important? Well, remember the great credit bust of 2009 that resulted in a near collapse of the global financial economy. That recessive period also meant complete financial annihilation for an incredible amount of private investors that tried to take advantage of the boom just before the bust. However, the problem for so many of them was an imbalanced portfolio. Essentially, they put too many eggs in one basket and lost it all, or too much of their investable equity, in something that took a turn for the worst. The best way to protect yourself as an investor is to diversify. You don't want all your money, for instance, to be tied up in a house, because while it is a significant investment, it could flood the housing market could plummet, or the mortgage could become too much to pay. If you were to lose the house for some unforeseen reason, and it is the only asset you have, you stand to lose everything. But if you have other investments, 401k, bonds, stocks, a business, whatever, you'll have a softer landing. The same could go for putting all your money into a single stock. Why risk it all when you can spread it out for better protection? This reminds me of a client of mine who had half of her investments tied up in her company's stock right up to a year or so prior to her retiring. So we, of course, rolled it over into a diversified portfolio in order to mitigate a risk. That was crazy. What was crazy about it was that just about 6 months before she retired, her company stock fell almost in half due to the market conditions. Let me tell you, we were unbelievably relieved that we had the chance to do that before that happened. All right. So now let's talk about charting your financial future. Okay. So one of the first steps to investing is getting clear on your goals. Of course, we all want a bigger return on our investments. That's a given. But for you personally, you have to ask yourself, why am I looking to invest for the long term? Before we get into your investment options, let's look at some of the important questions you need to ask yourself before getting started. Number one, why are you looking to invest? You need to determine if you're focusing on safety, income, growth, and whatever your main reason for investing and the time horizon you have for that is going to dictate that. Number two, how much can you realistically set aside? This is going to involve putting together a budget to see what you have left over that you can use to invest without compromising your current financial responsibility. Three, when will you need this money again? So you will need to decide if you're saving for retirement, which is long term, or if you're saving for a car or down payment on a house, which is all short term or medium term for that matter. Four, how much risk are you willing to take, or can you or your situation tolerate? Knowing this will help you to determine what types of investments are right for you. Now, finally, what should you invest in then? And that is why you're here today. So, for instance, if you've sold your house and you're looking for a new house within, say, the next 6 months or a year, say, you don't want to put that money into the stock market while it's sitting and waiting for the new house to be found. You want it to be invested in either cash or cash equivalent types of investments, like a short bond fund with very low fees or high interest savings account. Now let's look at some of the options when it comes to the types of investment accounts you should consider before starting your investment. Before starting your investment plan. Bullet point two. Get those notepads out. One of the first options for many people is a 401k account at their work. That's one of the first types of accounts to consider if it's being offered at your work. That's bullet point two. A 401k plan or account is the type that's offered at your work. If you work for a company offering an employer-sponsored retirement plan / 401k plan, it could also be 403b or 457, depending on if it's what kind of company you work for. If you work for a nonprofit or something other than a for-profit. Employee 401k contributions based on an income percentage you decide on. They are automatically deducted each pay period prior to taxation on gross earnings. Often employers will match employee contributions, which I greatly encourage at least to the match in order to contribute to at least up to that match in order to get the free money. So say your employer offers 100% match up to 3% of your salary, and you earn, say, $50,000 a year. Then the first 1,500 you contribute in the first period of deductions will be matched by your employer for a total of $3,000 paid towards your retirement account, of $1,500 from you and $1,500 from them. Now, to grow your retirement savings more effectively, you will need to invest the money that you are contributing to your 401k. Now, usually there are default options recommended for every 401k, or you can also choose your own. Some of them will actually let you choose your own optional investments from a list of other funds that they provide. Either way, a 401k is a very nice option because you can gain on your investments with no risk of losing what you have contributed due to a lack of discipline, because they don't let you take the money back once you put it in until you get over 59 and a half, or you have special situations. Maybe some of them will let you borrow, I think the most up to 10 grand for a house. Won't get you too far these days. That is because there are rules that most employers impose on those types of funds inside their plans, which usually their rules usually restrict, if not completely impede, an employee from taking their savings until they have reached either a certain age or have retired fully, thus not allowing folks to take the funds when the market is down. That's always the biggest mistake people do. They take the money out when the market's down. Now, say a person started the savings in a 401k at the age of, say, 22. Check out this chart here to see what they can expect to gain in a 30-year period if they started with, say, 5K and then only contributed $200 a month. You can see that a small amount can add up to a pretty sizable savings over that period of time. The chart shows a one-time $5,000 investment with then $200 a month or $1,200 a year for 30 years. That will accumulate to $284,000. I've shown some of my clients that are in these early in their 40s. I've shown them this just so they understood that by maxing out the 401k at $6K a year, which is the most you can do if you're under 50, $500 a month, until you reach age 50, then it can be $7,000 a year. They could have over $500,000, about 550 at 7% return. So it doesn't take, it doesn't take a lot for a person to be rich. The person doesn't have to really invest so much that it breaks them to really have a comfortable retirement, especially when they add their Social Security and they mix that too. Bullet point three. Get the notebooks out. Come on. Okay. We talked about the 401k. The other type is an IRA, an individual retirement account. Now that is a great retirement account option if there is not an employer-sponsored plan available to a person at their work. It's similar to a 401k plan. The IRA offers tax-deferred growth on your investment, just like a 401k, which simply means that your contribution will not be taxed until you withdraw the funds, preferably at retirement age. But there are two options. IRA options, different types of IRA funds. The first is called a traditional IRA. And a traditional IRA may be a good choice for anyone with earned income under the age of 71 and a half, and it may be tax deductible based on your income. With this option, you avoid paying taxes on your contributions, but will pay taxes when you withdraw based on current income tax rates. The other is known as a Roth IRA. Now, a Roth IRA does not have an age restriction. You can contribute forever, but is only income eligible. So you got to be earning income to be eligible to give it, to contribute. So you have to have a job or a business. The current restrictions are that contributors must have modified adjustable gross incomes in between 125,000 and 140,000 for a single person, and 198,000 and 208,000 for a married filing jointly couple. So, which means that if you're making more money than that, you can't contribute to it. Now, when you contribute to a Roth IRA, this option taxes contributions are made prior, which means there's no additional tax paid upon withdrawal. So it's post-tax money that you contribute. Now let's talk about some investments. Stocks, first and foremost, are also called, or can also be referred to as, shares or equities, are investments that represent a percentage of ownership in a company. So if you purchase a stock in a company, you become a shareholder. Your rights as a shareholder may include receiving dividends, which are company profits shared with shareholders, and even voting rights if you knew who the heck to vote for. Most people don't, right? However, your investment does not give you the right to any company assets. Stocks are made available by companies who issue shares as a means to raise large amounts of capital to grow their business, which in turn leads to higher profit returns and ultimately more money paid out to shareholders. If a company you are invested in goes bankrupt, though, assets can be sold to repay debts. But stockholders are the last investors to receive anything. So you could lose money on your investment in the worst case scenario when it comes to stocks. So also when it comes to stocks, there are different types you can buy. Let's delve into that just a little bit. Bullet point 4. Bullet point 4. Get the notebook out. There are 2 types of stocks. The first is called a common stock. As the name suggests, common stocks are the quintessential stock that most people refer to when talking stock investments. Common stocks offer shareholders dividends and the ability to vote on corporate matters, such as the board of directors. Now, the second type is called a preferred stock. So remember, bullet point 4, there are 2 types of stocks: common stocks and preferred stocks. Preferred stocks work a little differently, actually. Shareholders typically do not get a vote with these types of shares, but in exchange for voting rights, shareholders get paid first when the company pays dividends. So they take priority. Common stocks are generally riskier than preferred stocks because if a company declares bankruptcy, shareholders are typically last to receive payment after debts are paid. Whereas with preferred stocks, shareholders are typically paid first. Depending on your investment strategy, it's a good idea to have a mix between common and preferred stocks. However, If you are considering purchasing any individual stocks for your portfolio, I highly recommend that you consult with either a professional stockbroker or investment advisor who's well-versed on analyzing stock for its investment potential. There are many important metrics and considerations that are related to a stock before you invest into it. Things like the price to earnings ratio, the earnings per share, the market capitalization of that stock, the volume traded, the dividend yield. And that's really just to name a few. It's very easy to buy a good stock at the wrong time, and thus it may not end up being a good investment for you. So be very careful when considering investing into individual stock. I will tell you this as well. It has been my experience that almost all stocks fall in value when the stock market as a whole falls. Also, normally in the USA, the stock market is represented by the 3 most popular stocks indices, which are the S&P 500, the NASDAQ, and the Dow Jones Industrial Average Index. However, after falling with the market, not all stocks will go back up with it in unison either. In fact, most will lag behind most will lag behind it somewhat. As a result, it can be easier for individual stock to lose with the market, but not gain with it. So you got to be careful in individual stock. And you got to have the right expectations. This can be very frustrating for individual stockholders. Bulletproof 5. Come on, get the notebooks out. Another very common investment option that is part of most portfolios is what's called a bond. BOND. Unlike stocks that are equity investments, bonds are debt investments. A bond is a debt investment that entails an investor loaning money to a corporate entity or government. The funds are borrowed for a set period of time at a variable or fixed interest rate. Bonds are often considered a guaranteed moneymaker because they are very low risk option for investors. When bonds are issued by a company, the investor, aka the lender, typically gives the company a set amount. Let's say it's $1,000. And that's also known as the face or the par value of the bond. And in turn, the company promises to pay the investor a certain interest rate, also known as the coupon rate of the bond. Every year, in addition to repaying the initial $1,000 loan or par or face value amount back to the investor when the bond matures. So let's say it's a 10-year bond. After you get your coupon rate or your interest, which usually comes every 6 months, say it's a 5% coupon rate or interest rate, you'll get 2.5% every 6 months for 10 years. And then in that 10th year, you'll get your $1,000 back. Sounds pretty good, right? If you hold it the full period of time. If you sell it anytime in between, you'll be at the mercy of the bond market. Because that bond, the current bonds that are being sold at that time may have a higher or lower coupon rate. And you might have to do what they call discount your bond. Sell it at a lower price in order to get your money. And that's how it kind of works. If you hold to maturity, and most people don't these days, because to buy an individual bond, you got to have about $100,000 for most. So that's why people usually do it inside of mutual funds and exchange traded funds and that type of thing. It's a little more complicated then. Okay, so we invested that $1,000 in a 30-year bond. This time span is known as the duration of the bond. And it's a 5% interest, otherwise known as the coupon rate. That would mean a $50 payment each year. And then at the end of the 30-year period, $1,000 or principal investment is returned to the investor. Bonds have historically been the preferred option for balancing a stock portfolio because they help lessen the overall portfolio risk and provide an opportunity for consistent gains. They are also less volatile than stocks. And if you hold on to them until they mature, you'll receive income and principal payments, though the market value will always vary along the way. Of course, there are still some cons to choosing bonds as the primary non-correlated to stock investment option. As with most things, there are both pros and cons when it comes to investing in bonds. Let's take a look. The pros are that bonds are fairly safe investments designed to provide you with regular pre-scheduled payments. If it is a corporate or a non-government issued bond and the company declares bankruptcy, you'll be one of the first to receive compensation once the company's assets are liquidated. Even if interest rates decline, you are still guaranteed the higher rate. Now, first con, the interest payments from bonds are taxed higher than all other investment income. They're taxed at what's known as ordinary income tax levels. Now, if interest rates increase, you'll be tied to the lower interest rate. So if you're currently receiving, say, 2% and the market rates increase to 3%, you're still locked in at 2%, at that 2% rate. As a result, if you need to sell the bond, you'll have to sell it at a lower par or face value. This is also known as the discount rate, and it will cause your investment in that bond to lose value or return. You do not stand to make as much money as you would with a riskier investment like a stock. So it is important to create a portfolio that incorporates bonds in a way that meets your own personal risk tolerance level. Bonds were at an all-time low in 2020. The Fed fund rate that most influences the interest rates of bonds was between 0% and 0.25%. And then as a result of that, federal treasury bonds at that time were only bearing about 1 to 2% margin over this rate. However, the Fed has decided that they needed to aggressively increase rates recently this year due to the recent high inflation rates that we have seen lately, pushing towards double-digit inflation, up as high in the 8s and 9s. So currently, actually, as of today, you could get actually 4.68% on a 12-month T-bill. Now, bills, treasury bills, or bonds that are anywhere are between 3 months in duration and 2 years. And then you could get 3.85% for a 10-year note. Now, notes are treasury bonds basically that run from a 2-year duration up to a 10-year duration. And as of today, you could get 3.94% for a 30-year treasury bond. It's actually referred to a bond when it gets to the 20 and 30-year maturities. So you got bills, notes, and bonds, depending on their duration. As a result of this, it has caused the prices of the bonds that were sold at the previously lower rates to be down in value by as much as the long duration ones are down. The worst ones were down as much as 35% this year, the 30-year bonds. It's actually the largest decrease in the value of the bond market in its entire history this year. Recently, depending on the maturity of. So even though government securities are a safer investment than stock, they are by no means risk-free. This particular year, the longer durations were down almost double the amount that stocks were down. All right, now let's talk about mutual funds. They're another way to invest and diversify in the market and are often a newcomer for a go-to for when it comes to introducing people to investing. So what is a mutual fund? Well, it's essentially a money pool managed by a fund manager. The manager is responsible for investing the money into stocks and bonds, which means you do not have to monitor your investments as closely or often as you would have if you had to do it on your own. The plus side of choosing a mutual fund or an exchange traded fund for that matter, they work very similarly, is that you can diversify without paying numerous commission fees to a stockbroker. This is because if you had to make an individual investment, if you had to make all individual investments, you'd end up paying separate fees for each investment. One major drawback to owning a mutual fund is that they cannot be liquidated until the market closes at 4 p.m. each business day, Monday through Friday. So if the market's falling quickly earlier in the day, like it did in March 2020, when the pandemic hit, you can only put your order to sell it in at the end of the day at 4 p.m. because it will not be accessible to sell until the market closes. And of course, you could see substantial losses by then, and some people did. Another potential drawback to a taxable account with mutual funds in it is that since they're usually actively managed, more capital gains may be realized in any given year than if it was in an exchange traded fund. However, most good mutual fund management teams, like say in Vanguard, BlackRock, State Street, etc., they're some of the 3 biggest ones, are able to minimize these gains through creative and efficient investing. Okay, folks. Now you have a basic understanding of the types of investments that normally go into a market-based portfolio and the types of accounts. Let's now take a look at the most common types of investment strategies that are employed in order to pursue investment returns today. Final bullet point. Get them out. Get the notebooks out. 6. Bullet point. The types of investing strategies that are most commonly used. There's 4 of them. The first is called passive investing, also known as set it and forget it. This is basically how most Vanguard portfolios work today. The second is called active investing. So the first is passive investing. The second is active investing. Now, with this type of investing, there's asset managers make active choices on what to invest in and when. This causes investments in the portfolio to change periodically. It usually does not change asset allocation though, which we'll discuss in a minute what that is in the portfolio. So trades are usually made within the current asset allocation makeup. The third type of investing strategy is called tactical or quantitative investing. Tactical, Tactical, or quantitative. I'm not even going to spell that. Investing. You can figure that one out. Now, this is a type of active management executed by using algorithms that are fed market and or economic data metrics that trigger trades at predetermined thresholds. Now, these portfolios do not have static asset allocation to provide risk mitigation. Instead, they provide ranges of asset allocation. And I'm going to show you examples of this in a minute. So a moderate portfolio, instead of being set at, say, 50% equities and 50% bonds, it would have a range of between, say, 70% equities and 0% equities at any given time. Now, the fourth and final type of investment strategy is called protected or hedged investing. Protected or hedged investing. This is done by using stock options to protect from losses in the portfolio. This is most commonly seen in fixed indexed annuities and indexed universal life insurance products. These last two types of investment strategies are the ones that our firm has been leaning toward over the last couple of years. Let's take a look at that. The type of hedged or protecting investing that we prefer is the kind that's not done inside those types of annuities and life insurance. You can actually do it outside in the regular brokerage. All right. Traditionally, until now, most portfolios have had passive asset allocation choices based on each investor's personal risk tolerance, like these ones here in this slide. In order to accommodate large numbers of investors, every asset manager provides several investment portfolios that have different blended proportions of the asset classes that, when together, create a specific risk level for the portfolio in advance. They generally break down like this. Could be 100% what they call a fixed income or bonds. Bonds are also referred to as fixed income. And this is for highly conservative investors. Or it could be 80% fixed income and 20% equities. And this is just for what they call conservative investors. Or it could be 60% fixed income or 40% equities. And you can see how you walk down these breakdowns in terms of percentages, how it changes the risk level of the portfolio. So there are always some slight variations from these predetermined asset allocations as well, but these are the most standard combinations that you'll see out there today with most portfolio managers. Also, the individual investments within these asset classes, I mean, they vary tremendously from one portfolio to the next and from one asset manager to the next as well. It still will be made up of the same percentages between equities and bonds, but the actual investments will be totally different usually. Okay. Now, whichever investments that they use, they'll usually fit into either fixed income, bonds or equity/stock asset classes. Also, There's also usually somewhere around 2% of the assets that are always left in cash, or what they call cash equivalents, in order to keep some liquidity to be available for quick access to clients and portfolio periodic expenses. Now, when it comes to actively managed investing, according to the University of Pennsylvania's Wharton at Work newsletter, actively managed investments charge larger fees to pay for the extensive research and analysis acquired to beat index returns. Few are able to beat the markets consistently, according to the Wharton faculty members. Over the most recent 10-year period, active mutual fund managers returns trailed passive funds consistently, says Kent Smetters, professor of business economics at Wharton. On an after-tax basis, managers of stock funds for large and mid-sized companies produced lower returns than their index-style competitors, 97% of the time, while managers of small-cap stocks trailed 77% of the time. Okay, when it comes to investing, what historically has produced the best compound returns is the type of investing that minimizes the volatility of the portfolio, because it has produced a higher compound return versus the average returns. Now, your first thought when it comes to this consideration might be this: I didn't even realize that my portfolio's average return could be different than its compounded return. Most people don't. But in fact, it actually can be. And you can only really differentiate this by comparing the actual total dollars earned between two different portfolios that have the same average return. Also, the variable that causes this anomaly to occur is the difference in volatility between two different portfolios. That's the major variable, the difference in the volatility between the portfolios. In this slide you're looking at right now, you can see this clearly when you compare the two wavy lines that are representing two different portfolios on the top graph here in the slide. The orange wavy line, which represents the more volatile portfolio, has a range of positive 25% in a good year and negative 15% in any bad year. And the gray wavy line has a range of, say, plus 15% return in a good year and negative 5% in a bad year. And even though they both actually have an average simple return of 5% annually, the less volatile portfolio actually produces 42.5% return, which is actually a 5.3% compound, which is actually 5.3% compounded annually over 8 years, versus the other portfolio, a higher volatility portfolio, averaged 27.4%, or actually 3.4% annual compounded annually return in actual dollars. Folks, that's a difference of almost 2% annually. So this is a really big deal over the long run. Also, the spreadsheet below in the lower area of this slide shows the numerical breakdown of how the two portfolios arrived at these different compounded returns. I actually created this spreadsheet just so I could actually see how this worked in dollars. And I have to tell you that I was completely flabbergasted when I realized this several years ago. So at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk reward profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential overall long return in the long run. Okay, now you have a good idea of why it's so important for your portfolio to have a good risk reward profile and that keeps its volatility under control. You now know one of the main reasons why our firm has preferred and gravitated towards both the tactical and the protected investment approaches towards investing over the traditional static asset allocation approach that actually at once was so reliable for many investors, or so readily used, I should say. The bottom line is that one of the main priorities when it comes to tactical and protected managed portfolios is to minimize volatility, which in doing so also mitigates the risk of the portfolio drastically as well. These types of investment strategies have been used at the institutional level for many years now, but they have just become more accessible to the average investor through the different third-party money managers over the last, say, 10, 15 years. Finally, folks, if you came to this event, this webinar today, with the idea that investing is risky and it involves you tracking your contributions daily and trading based on trends to best monetize your investments, or maybe to find out if Bitcoin is the right investment for you, which I think by now, given the current major losses when it comes to it these days, most of us know the answer to that question. Well, I'm sorry to tell you that even though a lot of money has been made in day trading and in novel investments like cryptocurrency, although not recently, over the years, when it comes to the average investor out there today, these things are just not reliable enough to advocate for the long term, as far as I'm concerned. Plus, when it comes to things like cryptocurrency, which is a very hot topic today, I still can't find any definitive research that has convinced me, and I've been looking for a good reason to invest in it, or I was for a while, not now, that it is just trying to figure out that it's a good long-term investment for many reasons beyond the scope of this webinar. I just can't figure it out. And I think it can't be figured out. That's not to say that a very small percentage of someone's portfolio could be allocated towards to it or another type of high risk investment option. Some, few percentages, 4 or 5%, but very minimal. It just hasn't proven itself long term as of yet when it comes to the rules of conventional investing, which in a nutshell are that an investment must show long-term earnings potential and prove that through the metrics it produces on a quarterly basis year over year. Sure, many people do this type of trading and investing, but unless you have the time and are willing to take the risk, buying low and selling high is not the best option for most investors. The average investor is looking for a return with a set it and forget it mentality for long-term gains. With the market average ranging around 7% based on traditional passive investing, you can expect whatever you invest now to gain in 30 years about 7 times what it is or less. Your investment when you set it and forget it. So it's going to be about 7 times roughly what it was in the 30-year period. So It's my contention that due to the increased volatility in the equity and bond markets today, today's investors have to start thinking outside of the box if they want to have any chance of minimizing their risk and getting average returns that are anywhere close to what passive investors have gotten in the past. If the thought of doing your own research and navigating investment opportunities more work than you would want to put into your investing, you may consider seeking out a financial advisor to help you decide on the best investments for you, your budget, and your financial goals. A financial advisor does come with a fee, typically some percentage of the value of your assets annually. But what you get out of it is a professional who will be actively monitoring, evaluating, and diversifying your investments, as well as your overall financial plan. If you decide to go this road, it is very important, as far as I'm concerned, that you choose the right advisor for you. It's my recommendation to look for someone who emphasizes comprehensive and holistic financial planning versus someone who just manages investments. I say this because it's very important that all phases of your financial life, accumulation, deaccumulation, when you're spending it, and legacy planning for when you pass, or for things to be done in the most efficient ways when it comes to all aspects of your plan. Folks, this concludes the workshop part of our webinar today. We sincerely hope that these investing insights that we've discussed with you today are as helpful to you as they are with our clients, to us with our clients. Also, before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone that's attending our webinar today. Just for attending our webinar today, we want to offer anyone who we have not worked with before a no obligation complimentary investment or investing insights review. Plus, I want to take a minute to explain a little about what the review entails and what you can get out of it possibly. So this is what it entails. First, there's 2 ways we can actually meet to do it. The first is online using Zoom, which is almost just like how we're doing this webinar, but instead we'll both be able to see each other and hear each other, and it'll be completely private. Second, we can meet in person. People still do it, man. It exists, right? At our office in Fort Washington, it's just off the PA Turnpike. Now, in order to schedule it, Rachel will be putting up a link in the comment box right now or soon for you to book a 60-minute meeting on my calendar. Now, secondly, it is a 2-step process. We would meet together to gather all the information that I'll need to do the review. Then we would meet a second time to go over the results of it. Finally, what you can get out of this is a clear understanding of whether your current investment strategies are aligned with your investment goals and risk tolerance, and whether any of the investment concepts that we discussed today can be more suited for your long-term plan. All right, folks, we're now going to jump into our 6-question quiz and our Q&A session. Before we wrap things up, Rachel's also going to put up our resources. So let's start the quiz. First question. Let's get that music, Rach. Let's wow, I'm running out of water. What? Remember the bullet points. What is the number 1 most important rule to investing? Gotta tell us who put it up, Rach.
All right, it looks like we got Paul, got diversification.
Yes, diversification, Paul. Good one. Paul, do us a favor. Tell us where you would like your $10 gift card from. We like to do them through email usually. Amazon. Yes, that's the best one, I think, for email.
Mm-hmm.
All right. Number 2. What type of retirement account could be available to people at work?
Oh, Patsy
Patsy got it.
401k.
401k. Nice. That must have good bullet points this time, right?
Mm-hmm.
All right. Number 3. What type of retirement account is available to all individuals with working income? Especially if it's not available.
I think.
Oh, that's the first. That's one of the types, Paul. There's 2 types of this particular account. That's one of the types. We're looking for the second part of that name. It's a Roth what? Ah, Patsy got it. IRA. Patsy's on a major roll.
Mhm.
Although, Paul, there is such thing as a Roth 401k, but this is available to all people, regardless of whether they're offered at work, as long as they have income coming in from some type of work in general. It doesn't have to be W-2 employee. It could be somebody who owns a business. All right. 2 for Patsy and 1 for Paul, right?
Yep.
Very close though. I would have given Roth, but it just. All right. Number 4. What's the name of one of the 2? Just have to name one. One of the 2 types of stock that exist.
Oh,
Well, I
both. You
got
got
both.
common
of
and
them wrong.
preferred.
Nice.
Mhm.
Okay. Number 5. Name the other very common investment option that is part of most portfolios and is considered a debt instrument.
Oh, who got that? Right. I can't see it.
Paul got it. A bond.
Got it. Quick.
That was quick. Very quick. All right. Final question. Drum roll, please.
Yeah, we definitely got to get you some music.
Name one of the 4 types of investing strategies that we talked about. One of the 4 types.
Paul already got, he said passive.
Oh my goodness.
Paul and Patsy got it, but Paul was first.
All right. So Paul got what? 4?
1, 2, 3. Yep, 4.
Patsy got several of them, but she was just a little slow to the trigger. All right. So don't forget to put the place you want your well, we know Paul where he wants it. Put it up there too, Patsy. Where you want the
Raise my hand.
gift card from. Okay. So now let's look and see if we have any questions. Was there any questions at the beginning? Or maybe we could check the email here.
Let me get that pulled up. Hold on a second.
All right. It looks like we do got like 3 or 4 in the email.
Okay.
Yeah,
I've got one here.
there's a
Says,
couple different email here, but ones are dated from the other one. So these are dated 12/27.
okay.
Okay. What do you got there, Rach?
See. Do you think that passive investing with low fees, like with Vanguard, is the best way to invest?
Do I think that passive investing with low fees is the best way to invest? Well, it can be really good, I can tell you that. I think that it tends to be the best option, like a Vanguard or BlackRock or those type of big money managers, if you're in a 401k, because they may be some of your only options. However, the reason, and I mentioned this earlier, we're gravitating towards more of the tactical and protected investing strategies because we're trying to minimize the volatility of the portfolios to get higher compounded returns over time. And they're usually, that's a very specialized way of doing the investing. And it certainly can't be done passively. So that's my preferred way to do it. You see lower losses, you may see lower gains, but the consistency of that has proved out that I get higher returns. So the fees can be a little bit higher with that. Not outrageous if it's, you do it with the right, the right people. So I really like the passive low fee approach inside 401ks and retirement accounts at work. But to me, it's a second place to the tactical and the protected low volatility approach out in the open market. And the fees are a little higher, but I think the end result is a better return. And it's just a smoother ride. Difference between being on a roller coaster like this with your money and one that's nice and, smooth. When you're like 65 years old, I think you like the lesser, roller coaster. Wouldn't you agree? So yeah, that's my thoughts on that.
Okay, so next one. Why would someone invest in a mutual fund over an individual stock or bond?
What's the number one rule when it comes to investing? Remember I said it. These guys got it. All got it. The very first one.
Diversification.
Diversification. That's why, in my opinion, unless you're a great stock picker, like a Warren Buffett, and you got all that education and all that in-depth research, and you got like the it's not inside trading, it's more the inside scoop, because they go to the companies and they talk to the management, do all those types of, study them for years. Then in individual stock, well, obviously you can see with Warren Buffett, it's far superior. But for the average person, mutual funds, exchange traded funds can always be, in my opinion, better. Unless you get lucky on a good tip, which is, in my opinion, just luck. I can't hear you. Your
Sorry,
volume's
I was just saying, oh, I'm muted. Okay, you ready for the next one?
Yeah.
Let's see. Is now a bad time to invest because the stock market has not been doing as good as it has over the past several years?
Well, in my opinion, it's the best time to invest because the shares are lower. And when you buy in now, you get more shares. and there's a better chance for it to come up and ride the market back up. So anybody who hasn't invested now, I think, is the best time. One last one I think we have here, right?
All right. So let's see. What are the best kind of non-correlating investments?
Wow. The best kind of non-correlating investments. Well, in my opinion, non-correlated investments are tricky. Gold is a non-correlated investment. It's a commodity. A lot of people, keep gold in their portfolios. Well, they did. The problem is a lot of non-correlated investments, they lag for years on years. So even though it's not going down with the market, it's not going up. It's not going up enough to make it, in my opinion, a good non-correlated investment. It's non-correlated. I mean, it's not going up and down at the same rate as the stock market or the bond market. Has its own cycle, so to say. But you want one that, in my opinion, has, a good track record for being up more than down. So although you can find many, non-correlated investments, some of the best ones I've seen are really with the protected investing that are up more than they're down. That looks like it's about it, right? All right, folks, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic. I truly commend all you guys. Also, I want to remind you that if you have any questions related to this topic we covered today, or our offer of the no obligation complimentary investing insights review, or if we did not answer your question, or in the future you have another question and want to ask it, or anything else for that matter, and you'd like to discuss it with me further, or Rachel, Rachel put in that, she put the link in there for the 15-minute Q&A meeting. You put that in, Rach?
Yep.
And you can schedule that at your convenience with us. Well, that's all for today, folks. On behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area. Also, you can reach us at either 215-804-9708 or by phone, or at info@plcfs.com by email, or just make it even easier and just go to our website at plcfs.com, and all our information is always there. Also, please mark Tuesday, January 31st, the last day of the month, 2023. Oh my God, it's mind-boggling. We're here already. It's unbelievable. At 7 p.m. on your calendar for our next webinar. Remember, we do them on the last Tuesday of every month. Have a very, very happy New Year, everybody, and we'll see you next month. Good night, folks.
And everybody, Happy New Year.
Happy New Year.